So still affecting sentiment is the flow through of disappointing economic data from the US, the latest being that jobs number on Friday, where only 54,000 jobs were created in May. What's all of this indicating for you when it comes to the state of the US economy?
Well, I think that we're sitting in a ugly parade, as we call it. I mean, you're looking at the Eurozone, you've got the US, which is the uglier of the two sisters, and I think that's the kind of scenario that's unfolding itself. There is no real pretty picture when it comes to the peripheral zone within what's happening around Greece, Portugal, and Spain remaining under pressure. And then obviously in the US, abysmal data. I mean, on Friday we had the numbers which came in significantly lower than what the market was anticipating. I mean, market was looking for above 200,000, came in at 54,000, very, very low. And obviously the sentiment around that, bolstered by the negative data that we had throughout the week, driving that dollar negative sentiment and continuing to continue the fears that the US economy is not coming on track. I mean, if we look at the housing data, unemployment again ticked slightly higher at 9.1%, so not out of the woods, and that's why we're talking about the possibility that we may just see QE3 come back online.
Of course, do you, in terms of a view at Nedbank Capital, do you see things needing to go that far? Of course, we've got main focus this week on how central banks will respond to the slowdown, and we've got Federal Chairman Ben Bernanke speaking tomorrow, in fact.
Well, the market will be paying close attention to what the Fed, different members of the Fed are going to be making announcements this week, because we are getting, this is the month where they're going to make a decision around that liquidity that was injected into the system. Has it been adequate? Is it going to be sustainable should they decide to pull it out of the system? Those are the kind of questions that the market's going to be looking for. And obviously, in this scenario where we are not seeing that follow through, in other words, although there's all-time low interest rates, we're still not seeing a recovery in the housing market. We're not seeing unemployment come off from the levels that it's been at, and these are elevated levels. And that's the concern. Until they get the consumer back online and that economy back online, can they really afford to take the liquidity out of the system and keep start looking at hiking interest rates? I think the market had kind of hoped for that scenario towards the second half of this year, and that just looks as though we're back in the doldrums. We are living in almost a little bit of deja vu. And then, looking back at the euro, obviously that's benefited on the back of what's happened with the United States, seeing euro tracking back up to 146 again, quite significant, because we can potentially even trade up as high as 149, which poses positive opportunity for the South African rand.
Of course, that is also dependent to a large extent on what comes out of the ECB and its rates decision later this week. What are you forecasting on that front?
A lot of rumours in the market at the moment thinking that the ECB may announce an interest rate hike in the July decision. That's also being priced into the euro. So, for now, for choice, I think the euro, keeping in mind that the Eurozone is at the top end of their inflationary band. The UK is in the same scenario. In fact, they double their inflation band, but they're unlikely to be able to hike interest rates soon, although the pressure is starting to mount for the Bank of England in order to curb that inflationary outlook. But for the ECB, it will be interesting to see what Mr. Trichet has to say. Unlikely that they'll hike this time, but they potentially could do it in July.
When you're looking at the kind of activity that we're seeing on the currency front, though, I mean, we're certainly looking at currency markets acting as if it's a temporary slowdown that we're seeing, because if things were really out of kilter here, Brigid, we would see a pullback more dire than we have from risky assets, and that's certainly not been the case. Yes, a little bit of weakness filtering through to the rand, but it's still holding relatively strong.
I think we were actually having this conversation a couple of days ago and saying, what is a risky asset in this environment? Historically, emerging markets used to be risky assets, but now more and more we're starting to present ourselves with a debt environment that is unable to be managed effectively. And if you've looked at what happened with this whole potential for default in Greece, obviously the huge debt levels that they're running in the United States, are you that comfortable to hold onto a bond or a asset that previously was deemed as relatively risk-free in an environment that we find ourselves currently? It's actually flipping itself around, whereby the emerging markets that are running smaller account deficits, etc., and are better managed are actually those that are possibly the ones that have the least amount of risk attached to them. And South Africa's benefited on the back of that.
Well, with that changing status, we've had Trade Minister Davies saying that South Africa's rand currency is overvalued and that the government is currently discussing what to do about it. This, of course, standing in contrast to what we had Finance Minister Gordhan saying last month, that South Africa was fortunate to have a stronger rand and that the government would not intervene to weaken the currency?
Well, that's the thing, and I think that we've got to weigh it up. I mean, the rand at these levels offers opportunity for importing capital goods in order for us to create opportunity for our infrastructure. It also, with the interest rate sitting at these 30-year lows, potentially funding is a lot cheaper. You know, the currency itself has benefited, and yes, there's always going to be two sides of the equation. But the bigger picture here really is the fact that it's anti-inflationary. The rand being as strong as it is erodes a lot of the exogenous pressures that the Reserve Bank highlighted in their last MPC, that's being the likes of oil prices, the likes of food prices, all imported prices, that the rand, because it's slightly stronger, means that we see the erosion of that. So hopefully, you know, that will continue to keep us relatively well maintained. Obviously, the outlook still uncertain in terms of where we're going from here. The MPC was looking for 30 basis points again in terms of the expectation for inflation. But, you know, as we see the movie play out, unfortunately, the globe is still in a lot of turmoil, and specifically the high debt levels, which just don't seem to be contained, which means that your consumer continues to remain under pressure.
What options would the government have at its disposal, though, to bring some weakness in? Because we've seen South Africa last year spend over 15 billion rand helping the Reserve Bank to accumulate reserves. We've also heard the bank say that it does not target a level and rejected the idea of taxing capital inflows, such as, you know, the kind of measures we've seen implemented by the likes of Brazil.
Well, I think South Africa still relies quite heavily on those foreign inflows, and I think that that's something that we need to keep in mind, that, you know, in order to, if we start implying some form of tax, that is certainly going to deter a good portion of that. That being said, though, the Reserve Bank also did make it very clear that they didn't want to manage certain levels on the rand. What they rather wanted to do was create less volatility, so manage the inflows and outflows to the degree that, I mean, historically, we used to see the rand trading 20, 30 cents in a day. You don't see those kind of levels anymore. You're lucky to see maybe 5, if at an absolute push, 10-cent ranges for the day, which means that our rand is relatively well maintained. Foreign investment, you know, the foreign investors and certainly the local markets can budget around that a lot more effectively, rather than the huge volatile swings we saw historically. So from that perspective, I think that the South African Reserve Bank has done exactly what they set out to do.